Gerhard is something of an enigma. He's got 3 kids. He's fond of Land Cruisers. How many have you had now? 3 now, or 5?
Let's call it 2 for now.
He loves bowls, paddle, running, cycling. He was a scratch golfer. I think Gerhard would climb trees if he could. But yes, and I think the next thing is probably a Robben Island swim if Gerhard continues with this trend. Now let's move into something about how did you get to know Peregrine?
We were on our way to a mountain bike race, Melkbos to Rooibos, and we were sitting in a restaurant talking to a mate of mine. And in typical consulting fashion, Waldo eavesdropped. And he just said, "Did you guys talk about finances? I'm Waldo, I'm from Peregrine." So that was our starting point. So his wife was the marketing director of Carmine Tea, and that was the connection. We were on the way to the race that his wife promoted. So that's how I got to know Peregrine. So it's more about the personality than the investment firm.
Yeah, something that Gerhard didn't include there is he saw a very nice braaibroodjie on my table and he said, "That looks very nice."
Yes.
Yeah, both of us are fond of braaibroodjies as well. And apparently we like Peregrine now as well. Okay, so in terms of that, back to business, Gerhard. The idea in terms of our first conversation was, as you gave me a big intro into your firm, you told me the way that you guys look after money for your clients. You introduced me to everybody at your firm. How did you view your investment philosophy pre-Peregrine and post our conversation? How was it actually incorporated?
BetaPlus is a specialized employee benefits firm which runs on asset liability models. So we got a very specific purpose, enhancing people's lives by helping to retire better. So if you talk to any of my people, that's the first opening line. So to enhance people's lives by helping to retire better, you need a very firm retirement plan. So for me, working with Peregrine, 3 words comes to play. The number one is consistency. The other one is definitely sustainable and predictable. So the one thing our clients do not entertain, which they don't appreciate, is volatility. And due to the fact that we calculate every client's specific liability or their return objective, we need to get a portfolio that actually equals that specific return objective. And the easiest way was to have a blend portfolio that included the Peregrine funds. That in short.
Okay, so I think before we head into Peregrine and go into the deep delve in terms of how you incorporated this thing, I actually want to ask you to, let's say, elaborate on Imali for us and the way that you use the passive building blocks and the way that you actually blend the Peregrine funds with that.
So Imali is our own asset management company, which is with a small one fund CIS, and the investment philosophy is a passive portfolio with an active overlay. So we use passive building blocks with an active asset allocation overlay. That was very successful and still very successful, but the one element that it missed in non-regulation 28 portfolios is to take the volatility out of the portfolio, which by means of regulation 28, if you blend in too much cash, obviously it creates other issues. But from our point of view, Imali is a simple passive portfolio with an active overlay, and our main objective is to manage 2 things. Number one is definitely risk. Our whole life is risk, and obviously the performance. So when we mandate with our clients, you go into a multi-passive balanced portfolio, which is the regulation 28 portfolios. Our major objective is the client's got to agree on 2 things. You agree on the performance mandate, which is maybe a CPI plus 5, and you agree on a risk mandate on a scale between 0 to 15, where JSE all shares 15 and cash is 0. We agree with you on a specific risk parameter where your portfolio would sit, and that is on the regulation 28 portfolios. Yeah.
Pre-Peregrine, you use your Imali fund and the passive view of JSE 15 cash, let's say 0%. How did you incorporate the Peregrine funds post that? How did you find, let's say, something different in the funds, and what did that bring to the table for your clients?
At BetaPlus, in our early days, we made a decision to go for external DFM. So we used Grace One as a discretionary fund manager to supply information So on the Regulation 28 portfolios, it was quite simple. They managed the Imali passive balance portfolio with us very successfully. But a major part of our business is retirees. We look after about 25,000 employees, which daily got basically people retiring. When people retire, they go into annuity, which is non-regulation 28. It's not under the life license, so therefore you've got an open mandate with regards to which building blocks you can use. But you need exactly the same risk profile and performance objective to blend it in. Now, when we had our investment committee, one of the Grace one's suggestions was to bring in a hedge fund. Hedge funds is very much misunderstood. Hedge funds is a swear word where people think it is it's volatile. We actually use the hedge funds to reduce risk. Performance will always be there. The CPI benchmark will always be, if you look at the 10-year balance portfolio, it will always be 10% after fees. But the most important thing is, what is the risk? So by using my own fund, 40% Imali passive balance fund, blended in with the hedge fund, actually brought down the standard deviation or the risk in the portfolio substantially. Once again, making the returns consistent, predictable, and sustainable. That is what we were looking for. So we were not really chasing Peregrine's performance. When we look at the hedge fund, we brought it. That's the first blending in our model portfolio was bringing in the Peregrine hedge funds to bring down the standard deviation, but still have your return objective of CPI plus 6. The next step was, yes, now that we got Peregrine hedge fund in the portfolio, blended in with the Imali passive balance portfolio, how do we selfishly capture some more upside? And therefore we started to play with the growth fund. And now currently, as it sits today, it's 40% to our own fund. The rest of the money goes to Peregrine. Hence, you've got the combination of the three players in our Rapid team. You can't look at Imali in the isolation. You can't look at Peregrine hedge in the isolation. You can't look at the growth fund, Peregrine growth, in isolation. But those three funds combined over 1, 3, and 5 years will give you the best performance at the lowest risk, which obviously then manifests to my clients, get to their liability, which actually is their income and the sustainability of the income over a period of time. So that's how we brought it in, and that's the reason why we use the Peregrine funds. Is there other hedge funds? Sure, but then it becomes the other discussion. People that you trust, people that you know, and for me personally, people that's accessible. So if I need to speak to the right person at Peregrine, I've got access to them. Sitting at clients, say phone whoever and say, listen, can you jump into the meeting? And the most important thing from our point of view is we don't keep Peregrine we don't sell Peregrine. Peregrine sells itself. And we introduce Peregrine to our clients, and we create personal relationships between Peregrine and our clients, which obviously creates a lot of trust between me and my clients as well.
Okay. Yeah, and Gerhard, that actually speaks into something that I've experienced with you, and I think that's the way that you approach your clients as well, is everything is based on relationships. We've been going at this for 3 years now, where you and I have active conversations on almost weekly basis every now and then. And if I move back into this, there was never a question where you, let's say, lost value in Peregrine. You actually just wanted to know more. And the one thing you did ask me about one time was, let's say, drawdown protection. And how did you feel about it? There was a couple of market drawdowns. And what did you see came from the funds? Did you experience the true value of drawdown protection from the funds at that stage?
Well, typical example, we've been going on this solution for almost 2 years now, but the market was not really tested. It's quite simple for any advisor to make money when when the tide goes high, all ship floats. So when you look at specifically like April 2025, where you had a 10% drawdown in the market, this portfolio didn't take a smack at all. And the reason being is that for the first time, we tested a real market example whereby a client's opening balance and his closing balance in April, the beginning of April and the end of April was exactly the same. And the rest of the portfolios of the rest of the asset managers felt the pain. So the blending of the portfolio between the three players, Imali, passive balance, the Peregrine Growth and Peregrine Hedge just took all the volatility out of the market, and it gives clients that feeling of sustainability, consistency. So that was very important. So this is real life examples, and I believe we in the next 6 to 12 months we're going to testing this value again. So to answer your question, the drawdown for us is more important than the upside. So the downside protection is everything. The upside will always be there, but the question is, how do you protect the downside, the drawdown effectively without compromising the upside? And that is where we got the perfect solution between those three portfolios.
Okay, lovely. And Gerhard, let's say to add on to this, we found ourselves in a situation where you've got numerous clients that's in this portfolio. Do you have one, let's say, top of mind where you can actually tell us about a good experience that the client had that maybe drew too much income or that was very conservative and was scared of market drawdowns?
I got a very prominent family which were at the advisor, and the two old people between, let's say, 72, 73, they were living in Pretoria. The advisor said you can't have a proper drawdown on a specific portfolio. And after bringing them in the portfolio, we could almost give them 45% more income, live their lifestyle, enhance their mental wellness by doing a simple thing, giving them consistency and predictability, and give them enhanced returns. So it's not just by looking at a client and say, listen, this is the return or this is the risk. When you talk to retirees, there's two things. To create wealth is one thing, but to have mental wellness, to enjoy that wealth, is so much more important. And you see that when you walk out of the room after 2 or 3 months, and the guy phone you and say, "Thank you very much. We can actually go on holiday now. You can feel the thank and the gratitude towards you." And it was just a simple change by just making it consistent, predictable, and make sure it's sustainable. So that is what we live for. It's not just to create wealth, but to create wealth in such a manner that people can actually enjoy it after age 65. We are so hook up on the return side of it. But what about your employee, your clients to enjoy their wealth? Yeah.
Yes, Gerhard, thank you so much for this. Are there any final words or messages that you'd like to add about Peregrine, something that I never brought up or that you can think of?
Not really. I think if you want to deal with Peregrine, for me, I've said everything basically, but access to personalities, that's very important. Proper, honest relationships without bullshit. To know every single month that your book will grow, your clients' wealth will grow, and it's consistent, predictable, and sustainable. And I could not say it better, but Deirdre, my wife, said, remember to say, what does Peregrine stand for? And I think I said it over and over. The one side, I would argue it's consistent, predictable, and sustainable, but it's definitely performance. It sells itself.
Thank you so much, Gerhard. And I'd like to thank you for your time. You should enjoy your time off now. And we really appreciate your input here today. Thanks.
No problem. Thanks.